All right, welcome back, focused learners and strategists. Today, we're stepping right into the role of your expert advisor to unpack what has been a truly chaotic week in the markets. We are looking at an environment right now that is actively testing every single nerve in your portfolio, especially if you're a newer retail investor just trying to find your footing in this space. So this explainer is entirely dedicated to navigating the current crypto market's massive clash with overarching macroeconomic forces. We're going to slice right through all the noise, focus purely on the signal, and equip you with the strategic framework you absolutely need to protect your capital. We'll break down your weekly strategy, and more importantly, we're going to review the core security practices you need to master to safeguard your hard-earned assets when these markets get, frankly, extremely choppy. Let's get right into it.
Okay, let's dive into this by grounding ourselves first with Bitcoin's current, highly volatile standing. Right now, we're looking at the $64,515 level. And look, this past week was nothing short of a roller coaster. We literally watched massive institutional flows clash directly with surging macroeconomic fears. Bitcoin got absolutely thrown around. It was dragged hard under the $64,000 mark temporarily, but in true crypto fashion, the bulls stepped in at the lower bounds, violently clawing the price back up to this equilibrium. Now, why does this specific price level actually matter structurally? Well, the mid-64,000 range has historically acted as a massive psychological and technical battleground. It is the dividing line between previous all-time high consolidation and a breakdown into bearish territory. So when you see this kind of violent price action happening right in the middle of a major range, it's an immediate signal. Major structural forces, bulls and bears with incredibly deep pockets, are locked in a total war for directional control.
Seriously ask yourself, are you flying blind into a Category 5 hurricane? If you're a new investor, or you're actively trading right now without looking at the underlying on-chain data, you're essentially ignoring the radar while the storm rolls in. The macroeconomic gods are actively battling institutional crypto flows as we speak. The real danger for a new retail investor here is getting caught up in the emotional swings of a 5-minute chart without realizing that the overarching macro environment is what is actually driving the bus. The fundamental question is whether you're reacting blindly to the daily algorithmic noise, or if you're taking the time to truly understand the structural shifts happening beneath the surface. To survive this market chop and protect your capital, we simply cannot afford to fly blind.
So the crucial point is the massive knowledge gap staring us right in the face this week. According to the latest on-chain data, exactly 60% of Bitcoin's circulating supply is currently sitting in profit. Think about that dynamic and the tension it creates for just a second. With the absolute majority of holders currently in the green, it creates an environment ripe for sudden, violent volatility. Are we gearing up for a parabolic face-melting breakout because the market is healthy and holders are refusing to sell? Or is this just an exhausted recovery that's about to aggressively roll back over as whales decide to lock in their gains, take their liquidity, and run? The answer to that tension actually lies strictly in the broader macro data and the bond market, and we're going to expose exactly how that works today.
Here is our visual playbook for this explainer. 1. The macro market pulse. 2. Ethereum institutional plot twist. 3. The 60% profit dilemma. 4. Next week's critical watch list. 5. Macro trading masterclass. And 6. Spot versus ETF derivatives.
Section 1. The macro market pulse. Traditional finance fights back.
We really need to analyze how traditional finance is currently pushing around the crypto market, because as you know, crypto absolutely does not exist in a vacuum. Over the last few days, surging U.S. bond yields have essentially acted as a massive macroeconomic headwind. When bond yields surge, it boosts the odds of a Federal Reserve rate hike, or at least the market's perception that we're going to have tighter monetary policy for a much longer period. Let's break down exactly why this matters so much for a beginner retail investor. You have to understand the concept of the risk-free rate. When institutional investors can just park billions of dollars in U.S. government bonds and get a guaranteed, basically risk-free return of around 5%, their appetite for holding highly volatile risk assets drops significantly. I mean, why take on the massive risk of Bitcoin swings if the government is handing out guaranteed yield? This dynamic immediately sends shockwaves through risk assets, dragging them down as capital rotates to safety. This is exactly the macroeconomic pressure that temporarily dragged the Bitcoin price hard under that $64,000 mark. Traditional finance was fighting back, and Bitcoin, functioning as the ultimate risk asset, took the immediate hit.
Now, when Bitcoin plunged below $64,000, it triggered a massive cascade of liquidations for late-to-the-party long traders who were completely over-leveraged. But for the structural traders playing the range, that dip represented a pristine mean reversion setup. Mean reversion is simply an asset's tendency to snap back to its long-term average or equilibrium price. If you were watching the order book depth during that plunge, there was a massive buy wall at $63,800. Institutional limit orders were stacked up and it held like absolute concrete. This provided a perfectly defined risk-to-reward ratio for structural traders to step in, buy the fear, and force that bounce back to our 64.5K equilibrium. They knew the macro panic had overextended the price to the downside.
Section 2. Ethereum Institutional Plot Twist. The ETF inflow streak breaks.
Let's transition over to the Ethereum ecosystem for a minute, because the hyper-bullish narrative we've been tracking just took a sudden and very aggressive detour. Right now, Ethereum is hovering at $1,879. It's currently trapped in a very tight, low-volatility wedge. The massive institutional plot twist here is that the highly anticipated Ethereum ETF inflow streak abruptly closed out the week in the red. This violently ended a 5-day continuous inflow streak that had the entire market acting hyper-bullish. Wall Street is clearly taking a breather. They're likely rebalancing their portfolios as they digest that exact same macroeconomic bond yield data that's suffocating Bitcoin right now. And for savvy traders, a massive warning sign flashed right before this happened. The momentum oscillators flashed what's called bearish divergence on the 4-hour timeframes. For those of you new to reading charts, bearish divergence happens when the price of an asset continues to creep up and make higher highs, but the underlying momentum indicator, like the RSI, starts making lower highs. It's essentially telling you that the buyers are running out of gas. It's like a car that's still rolling forward, but the engine has completely stalled out. When that streak broke, it was the signal for pros to short the local top or tightly protect their spot bags. So now we just wait for the next major catalyst to force a definitive breakout from this $1,879 wedge.
Section 3. The 60% profit dilemma, psychology as resistance.
And this brings us right back to the on-chain reality of the profit dilemma we highlighted at the very beginning of this explainer. When 60% of the Bitcoin supply is profitable, human psychology actually becomes the ultimate resistance level. It's not just about moving averages and lines on a chart anymore, it is entirely about the very real human fear of losing unrealized gains. Think about it from the perspective of a retail investor who is finally up 20% on their portfolio after a brutal year of pain. Every single minor dip in the market suddenly feels like a frantic race to secure profits before the market turns against them again. This creates incredibly heavy, localized selling pressure at every single resistance band on the way up. As an expert tip for new retail investors navigating this specific psychology, the structural trade here is not to blindly buy a breakout just because the price pokes its head above a line. Instead, you wait patiently for a confirmed daily close above those local highs. That confirmation is absolutely vital. It proves to you that new aggressive capital is actually stepping into the market and successfully absorbing all of that panicked sell pressure from those currently profitable holders.
Section 4. Next week's critical watch list. Filtering the signal from the noise. Pivoting from what just happened to what we actually need to watch next, let's build out our forward-looking watch list so you can filter the actual signal from all this algorithmic noise. As your weekly strategy moving forward, keep your eyes glued to these 3 specific metrics. First, the 10-year Treasury yield. As we just deep-dived, the macro environment is currently the puppet master, and Bitcoin is the puppet. If bond yields continue to surge on Monday morning, you should absolutely expect Bitcoin to violently retest the lower bounds of its support zones. The golden rule right now is do not fight the Fed and do not fight the bond market. Let them make the first move. Second, monitor the ETF flows. We really need to see if Friday's red close was just a temporary institutional rebalancing act or the start of a broader exodus. If the ETFs print red again on consecutive days, watch the $1,850 support level like a hawk. If ETF buyers don't step in, expect Ethereum to slice right through that floor. Finally, geopolitical developments. This one is absolutely massive. A major Bitcoin advocacy group officially joined the U.S. State Department's Digital Freedom Program. Regardless of any political leanings, strictly looking at this from an adoption standpoint, this dictates the structural trend for the rest of the year. We are actively moving past the phase of regulatory hostility. When global nation-states begin explicitly engaging with and utilizing Bitcoin infrastructure for broad geopolitical strategy, the entire paradigm shifts from being a speculative asset to a sovereign necessity.
Section 5. Macro Trading Masterclass. Surviving Yield Curve Panic.
Let's move into our Strategy and Systems Masterclass. Today's lesson is specifically engineered for surviving macro-induced yield curve panic. When broader financial markets are reacting violently to rate hike odds, technical analysis on lower time frames becomes incredibly unreliable. A support level that looks amazingly solid on a 15-minute chart will get completely obliterated in seconds by a sudden macro headline. So the system protocol for new retail investors is pretty simple. Step 1. Widen your time frames. If you usually trade the 15-minute chart, move to the 4-hour. If you trade the 4-hour, move up to the daily. By zooming out, you effectively filter out the headline-driven chop. You want to identify higher time frame structural boundaries, like Bitcoin's hard historic floor at $60,000 and the ceiling at $67,000, and just completely ignore the chaotic emotional price action happening in the middle of that range. Step 2. Adopt the confirmation doctrine. In a volatile market where 60% of supply is in profit, never buy the anticipation of a breakout. Let's talk about why beginners constantly fail this step. It is entirely due to FOMO, the fear of missing out. It's psychological agony to watch a massive green candle shoot up and feel the intense urge to just market buy, terrified that the train is leaving without you. But more often than not, that spike is a trap. Let the aggressive, impatient traders take the risk of trying to break through the resistance wall. Let them fight that battle. Once they punch the hole and the price structurally closes above the line on a daily time frame, then you enter on the retest. Yes, you might sacrifice a small percentage of the initial move, but you exponentially increase your win rate and you protect your capital by avoiding the fake-outs that wreck impatient retail traders.
Section 6. Spot versus ETF Derivatives, Risk Management, and Asset Sovereignty.
Bringing it all home, we need to address a critical community topic regarding asset custody, core risks, and specific security practices in this volatile macro environment. We love getting these types of foundational questions from you all because this gets right to the core mechanics of risk management for beginners. User CryptoArchitect99 asks, with ETH ETFs ending their inflow streak, is it fundamentally better to hold spot ETH in cold storage or ride the ETF momentum? This is the exact ongoing debate between paper derivatives and true self-custody, and understanding the core risks between the two is absolutely paramount for protecting your personal investment accounts.
So let's break down the brutal truth and highlight the core risks here. An ETF is an incredible vehicle for traditional capital, sure. It allows you to gain price exposure without the operational friction of managing private keys. And let's be honest, for a lot of beginners, setting up a digital wallet is terrifying. It comes with deep fears of common, devastating security mistakes. For example, beginners constantly make the critical error of taking a photograph of their seed phrase with their smartphone. They are completely unaware that the photo automatically uploads to a cloud drive where hackers are routinely scraping data. Or they fall victim to phishing scams, like connecting their wallet to a fake website and accidentally signing a malicious smart contract, which is commonly known as a wallet drainer, and poof, it immediately empties their entire account. The ETF removes all of that self-custody friction. However, an ETF is a derivative product. It exposes you to major counterparty risk, ongoing management fees, and crucial trading hour limits. If the global market nukes by 20% on a Saturday night due to an unforeseen macro event, the ETF holder is completely trapped. You literally cannot sell. You are stuck until traditional markets open on Monday morning. You have zero liquidity during the weekend. On the flip side, successfully holding spot ETH in cold storage guarantees you sovereign liquidity 24/7. You do not have to ask a custodian or a bank for permission to move, trade, or protect your wealth.
For the sophisticated investor, and really what we advise for newer retail investors looking to navigate this landscape safely, the answer is usually a hybrid approach. You can use the ETFs in your tax-advantaged retirement accounts to capture the upside of the asset class without triggering massive capital gains events. But you absolutely must maintain a robust, separate cold storage stack for absolute sovereignty. If you are going the self-custody route to maintain that sovereignty, here is your definitive 3-point checklist for protecting your personal investment accounts. Number 1. Always use a dedicated, offline hardware wallet for your long-term holdings, never a hot wallet connected to the internet. Number 2. Manually write down your seed phrase on metal or paper. Absolutely no digital copies, no photos, and no cloud storage, ever. And number 3. Whenever you are moving capital, always send a tiny test transaction first, verify it arrived, and only then send the main balance. By understanding the exact utility of these financial tools and respecting the security checklist, you construct a portfolio designed to survive both massive macro financial shocks and localized crypto volatility. Use the ETFs for tax efficiency, but use cold storage for undeniable ownership.
So, to synthesize everything we've covered in this explainer today, the market is currently in a highly delicate balancing act. Bitcoin is actively fighting traditional finance headwinds, Ethereum is waiting for institutional flows to wake back up, and the looming threat of rising bond yields is keeping absolutely everyone in check. Do not over-leverage into this algorithmic chop. Wait for the macro data to settle, let the charts print clear, undeniable structural boundaries, and execute your system with absolute cold precision. My final question to you is this.
Will you let short-term macro noise distract you from your long-term sovereign mission? Keep your risk strictly defined, protect your capital with pristine security practices, and stay focused. We will see you back here next time.